Okay. So this is the lecture for week 8. We're focusing on money, which was originally I thought not very relevant, and then we got a stimulus package and we have to make new money. So congrats. This is an exciting and relevant lecture. Before I get into it, I want to note that there are a couple videos and announcements that describe what is happening in our class, but this is going to be the last new content until we resume after spring break. So anything that's been assigned so far is not due until we start again following spring break, and all the details on due dates and all of that stuff is in the videos in the announcements. If you have questions, go to the discussion boards first, and the office hour information is also all up and corrected in announcements. Cool. All right, so money. Right, we're both very familiar with it and not. There's sort of this joke that money doesn't exist, but it's like only half a joke. So when economists are thinking about money, we don't just take for granted the like stuff in our wallets. You have to like specify very concretely what the thing is that we're actually inquiring into. Okay, so when economists talk about money, which you can hear me when I talk to the wall. Well, when economists talk about money, what they're talking about is something that functions as a medium of exchange. A medium of exchange, right? That's the name of this week. That's really just some way to facilitate transfers. So anything about barter systems, pretty much anything can become a medium of exchange. Right, so that, right, so when you move from a barter economy, we have anything as a medium of exchange. Like if you want this piece of chalk, then you can have the piece of chalk, and if I want your notebook, we just exchange, right? What money does is it facilitates that exchange. So if you want this piece of chalk, you person want this piece of chalk, but I don't actually want your notebook, you can buy it with money and I'll take that money somewhere else and find something else that you want, right? So money is just a medium of exchange. It facilitates moving goods from one person to another. It is also a unit of account, less exciting and more straightforward. Unit of account is just a way to track movement of goods. So when we're talking about GDP, for example, we're talking about all of the goods that have been produced or all of the goods that have been bought, but we're counting it in money terms. So money, we're looking at it in terms of US dollars or in terms of euros or whatever. So money allows us to account for all of these different goods instead of having to add basketballs to more chalk. We can just count them in terms of money. Okay, so that's that part. Money is also a store of value. So something as a store of value means that you can put it away and it will retain that value, right? It doesn't disintegrate immediately. Whether it's in a bank or in a mattress, it still keeps its value into the next season. So that's different than something like clothes, which even if they're not worn, tend to lose value as the next season approaches, right? Because we don't need swimsuits as much in the winter. Or if we're very fashion conscious, we are over it. Bell bottoms don't go for as much as they used to in the early 2000s. Anyway, okay. Money, it's however, does retain its value. Now we're going to talk about inflation, which affects this somewhat, but more or less $1 bill is still worth $1, even though that dollar means less. That part's tricky, but we'll get to that. So also just in general, so these are the characteristics of money. This is what money allows us to do. Here are these sort of like adjectives of money. So this is not true of all forms of money, but most of them, most forms of money are good at what they do, are good at being a medium of exchange, are good at being a unit of account and a store of value because money has these properties. The properties being it's standardized, all of the quarters look the same, or there are a few designated designs that all quarters must adhere to or look like. It's durable. It takes a very long time for a quarter to wear down. And even when it comes to paper currency can be replaced if it does break. So it's durable to its extent, but it can't rip paper currency, but you can always get it exchanged by the bank for new unripped currency, right? So it maintains its value through that, which makes it durable. It's portable. Not all currencies have been portable. Some currencies are very big and heavy and stand like statues. But in general, currency that is portable, I can put it in my pocket and take it around with me, bring it to the store, do a better job of facilitating exchange, for instance. Scarce. So we talked about scarcity a little bit. And when something goes from being limited to scarce, the idea of scarce here is it doesn't grow on trees. Our unit of account has to be found. Even when we're going to talk about Bitcoin a little bit, when you think about cryptocurrencies, even those have to be mined. So even though there's digital populations, they have to be extracted through a virtual process in order to be found. They're not just lying around everywhere. So that element of scarcity helps money maintain its value. Short, easily divisible. Again, not all money forms have been easily divisible. Which is to say, if we only walk around with $100 bills, it would be really hard to buy things. So being divisible means we have different units of currency that we can break it down into. Different from like other forms of currency, which have been large and statuesque, not very portable, and have value because of their size. And so because of that, they can't really be broken down. Okay, cool. The last thing about money, and this is part of what gives it its most ephemeral quality, is that it's generally acceptable. Which is to say, money isn't much good if people won't accept it for exchange. Right? Generally acceptable. Generally is a really ambiguous word, right? So if something is generally acceptable, I can take it to most places and use it for currency. So in the area, US dollars are generally acceptable. If I get closer to the Canadian border, sometimes Canadian dollars can become generally acceptable even inside the United States. People will just take them, depending usually on the exchange rate. Similarly, if you're in Canada, close to the border, sometimes they accept US dollars anyway. US dollars are accepted in many other parts of the world other than the United States, actually. And we'll get to that too. So the generally acceptableness of money is unlike these other qualities because it has to be determined outside of the thing itself. So the dollar is portable because it's small and lightweight, right? It's been standardized. There's a printing process and a type of paper and a type of ink that must be used. That's all sort of innate to the good itself. whether or not we accept a piece of paper in exchange for other goods, has more to do with a social contract of sorts, a social contract and a value guarantee. So there's three main ways at present that those things might come to pass. So one is fiat money. Another is, we'll go through. Another is commodity money. And the last is cryptocurrency. I'm going to start in the middle actually with commodity money. Commodity money is something that is generally acceptable because it has intrinsic value. So that's thinking about like gold coins. A gold coin has a particular weight. It's a particular amount of gold. By virtue of being a particular amount of gold, it will always be valuable relative to other coins of other sizes. It maintains it because we believe that gold itself is valuable. Right? So that's sort of like we're talking about diamonds versus water. Like diamonds have a value that's preserved inside of the diamond, not because we can do anything particularly with the diamond, but because we believe that the diamond is valuable. So long as we believe that diamonds are valuable, we can continue to exchange them for other high value, high price goods. Okay. Fiat money is government-backed money. So fiat money is money that the government says they will reimburse you for. So this $20 bill is ripped. Can I go and exchange it for another $20 bill? Can I pay my taxes in this money? Does the government use this money in order to pay for its own expenses? That government belief and basis behind that money. So the US government uses US dollars, it pays people in US dollars, it accepts US dollars. Because of that operational investment in US dollars, the rest of us can be assured that our US dollars will continue to be accepted by anybody else inside of that community. Bam. Okay. So in this case, we just believe that the thing has value. In fiat money, the government continues to use it, and so we believe that it has value. And this continues to help out the value of our dollars as long as we believe in our government. So we'll talk a little bit about inflation later, and countries where the value of their money starts to spiral because people lose faith that the government is going to be able to maintain the value of the currency and their economy. Yeah. Cool. Cryptocurrency is, right, Bitcoin and the other ones, right? So are different types of currencies that exist only digitally, and the reason, and they are becoming generally acceptable. So cryptocurrency isn't usually included in this classification, but cryptocurrency is becoming more generally acceptable, which is to say there are more websites that take it. There are people who live their entire lives on the basis of cryptocurrency and pay for whatever they need by virtue of cryptocurrency. So it's not accepted at present moment at the bodega, but is spreading around. And the reason why this money stays afloat is because of what's called the blockchain. So it is not my realm of expertise, but as I understand, a method of programming that makes it such that no individual person is responsible for the data included. So the transactions are protected from any one person or really any group of people manipulating that data, because it's disaggregated along the pathway itself. So the more wider the more widely it's used, the safer the currency is. Cool. I'm gonna pause there for a second. Give you a chance to think about monies that you use. So in the discussion board, one of the prompts is to think about monies that you use aside from US dollars, and think about, do they have these characteristics, these adjectives? And how does it function as a medium of exchange, a unit of account, or a store of value? Is that other currency that you've used a fiat money, a commodity money, or a cryptocurrency? Right, so head to the discussion boards. That might be a way to answer one of these. And I'm going to pause this, give you time to think about that one. Okay, so now we're going to get into the debt part of money, which is holding a negative amount of future dollars. That'll make sense soon. Okay, so when you think about personal debt, right, we have this bathtub model that we kind of did once. We think about debt. This is my, in here is my wealth. It's a stock. It's just there. It's not flowing or moving. It's either big or small or negative. And then, down the drain is consumption. So this is like your personal pocketbook. You've got whatever wealth you have, big, little, or negative. And you've got, you're depleting that with consumption. If it's negative or zero, right, you should have some kind of shower head situation. Let's see, is that up there? Good. Okay, so that's your income. So you've got water coming in through the shower head, that's your income, consumption going out, right? And then sometimes we talk about depreciation, but we can leave that kind of aside. That's the evaporation part. Depreciation of resources is like my car only gets worth less. My house only gets worth less in some situations. Or yeah, like the things that I have are deteriorating in value. That's that depreciation part, but we can leave that aside for now. So just looking at a model that has income coming in, wealth, and consumption going out, we know that in order to maintain this body of wealth, not deplete it, we have to be earning more than we spend. Right? If we're spending more than we earn, then the drain is draining out faster than the shower head's coming in, and this is going down. If we're earning more than we spend, then this is not so much, and this is coming in really heavy, and we're growing our wealth there, right? Okay, so what do we do when we have to make income decisions that, or consumption decisions that can't be satisfied by the wealth or income? Because when you think about this model, you can say, if we keep consumption equal to our income, then we can maintain our wealth. If we need to save, we spend less. And sometimes we need to consume more than we're receiving, which means that if we have a positive amount of wealth, that we're decreasing that amount of wealth. And it means that at some point we might even be taking on debt, which is negative wealth. So it's hard to visualize in this particular situation, but the bathtub has been emptied, and indeed we're, drying out the surrounding areas, trying to figure out how to pay back that debt. All right, so we can understand that on a personal level. Sure. Okay, so one question to you that you might use for the discussion boards if you want is in what order do you make these decisions? How do you think about consumption, income, and wealth in your own personal lives? All right, so what happens when you need to make consumption decisions and you have not enough wealth or income altogether? That's when we start borrowing. So when we borrow, what we're doing is, one way of thinking about it is that we're borrowing from ourselves in the future, because eventually we'll have to pay it back, right? So you can say credit, if I take on credit, like a credit card, when I use a credit card, then I am taking on debt. And that debt, right, that's negative wealth. So when I take on debt, what I'm doing on my own personal accounting sheet is borrowing from the future. So if I borrow $100 now and I have to pay it back next year at a 5% interest rate, I'll have to pay back that $100 plus 5% of that, which is $5. So I can have 100 now, but it means that I have to pay back 105 later. Right? And so we know that when the interest rate moves up to 10%, that makes the cost of borrowing $100 now more expensive, because next year, instead of paying 105, I'll be paying 110. Right? So as the interest rate goes up, the cost of borrowing from my future also goes up. Interest rate goes down, then it becomes more attractive to borrow from my future. Right? Okay. So that's how it works for a household. For a household, if you don't pay back your debt, there are consequences, right? So usually in the form of people coming after you and looking for the money that they believe you owe them. So there's some kind of enforcement mechanism, right, to keep in place that idea that debt must actually be paid. It's not a meaningless debt. Right, which plays into that idea of the idea of money, that we believe that the money is valid and therefore it is. So let that thread just keep going through. Okay, so right. So the way that interest rates influence is that if interest rates are more expensive, then we have a harder time being flexible on our consumption. So when there's high interest rates for individuals, we might be either stuck consuming whatever little we have, or we might be stuck in the future having to pay back exorbitant interest rate expenses in a time of desperation where we needed a lot of debt. Okay, so right, so that's how that can work in our personal lives. Another way of looking at borrowing credit, right, is in terms of assets and liabilities. So assets are things you have, things that belong to you. Remember, we were talking about ownership and the way that capitalism works, and the way that it assigns ownership and the rules of that game. Well, assets are everything that you own. And in particular, in this financial context, anything you own that has monetary value, right? All right, and so on the other side of that, liabilities are what you owe. So when we talk about a balance sheet, whether it's your balance sheet or a bank's balance sheet or a national balance sheet, what we're talking about is a list of all the things that that government or person or bank owns, and all the things that they owe back to somebody else. So if I take out a loan from my bank, I will get, $100, sure. I take out $100 loan from my bank. I get $100, right? So that becomes something I own, is $100 in my hand, but I am also liable to the bank for another $100. So I have a liability to the bank for $100. That bank lost $100 cash because it gave it to me. So they lost that asset of $100. They gave that $100 to me, but they gained another asset, which is my liability. What? Okay, so when I take out a loan from the bank says, here's $100. And I say, thank you, bank. And then the bank has less $100 and I have more $100. Cool. So then that's that, assets part. That's just the cash part. So their assets went down 100, my assets went up 100. But there's another part where I owe that money back. I don't get to keep it forever. So by taking that $100, I also owe another 100 back to the bank. So my liabilities have gone up because I am liable, I am responsible for $100. It's what I owe back to the bank. Now, the real tricky part is that for the bank, my liability to them, what I owe them, is their asset. I owe a bank $100. They own $100 that I have yet to pay them. So, so sit with that for a second, right? So we can, I'm not going to give you too many balance sheets, but I just want to throw that idea out there because it's going to come in a little bit when we think about government debt and how that gets paid out. Okay. So I'm going to leave that there in terms of personal financial information with the following one little tiny thing that we're going to add here. So we talked about the wealth part, we talked about the interest rate part, we talked about the assets and liabilities. So the other thing that happens with money in our personal lives, just the one other thing, is that the nominal amount of our liabilities in particular remains the same, while the real amount of what we owe tends to change, by which I mean, if you think about inflation, we've kind of alluded to inflation before, but we've never really talked about it. Inflation is the general upward moving of prices. The thing where movie tickets cost more than they did in 1950s. Just sort of, not all of it is because the movie industry is thriving. It's just, so some of it is just that dollars have changed in value. So inflation is upward movement of price level. We'll come back to it. Dollars are decreasing in purchasing power. It takes more dollars to buy the same thing as it did before. Okay, cool. So when it takes more dollars to buy the same things as before, say it this way. I owe the bank $100, right? I borrowed $100. So I have that liability. I owe the bank $100. And between when I borrowed it and now, so when I borrowed it sometime in the past and now, inflation has gone up. So that $100 can't buy as much as it used to. I can't get penny candy anymore. I can't buy as much as I used to with the same amount of dollars, right? So I have that $100 becomes worth less. So even though I have to pay it back plus interest, it might not actually even be worth as many things in real terms as it was last year, right? Okay, so $100 is the same. I have the same interest rate. If I have, sure, if I have, if I take out a loan of $100 and inflation is 5%. This is really a reversal of how the world works, but just imagine that inflation is 5% and interest is 1%. Then what I owe in nominal terms will be $101, right? This original 100 plus that 1%. However, okay, so however, what I pay back in real terms, what I owe in real terms is going to be, this is going to be an approximation because I'm not doing the math in the moment, but in real terms, in last year's dollars. See, inflation went up 5%. So what I bought for $100 takes 105 now. So that's about $95, right? So because the value of the purchasing power of the dollar has gone down, it doesn't really matter that I'm parting with slightly more than what I had before. However, what's usually the case is that these are switched. So I'll have an inflation rate moving around 1, 2%, have interest rate 5, 25, 30%. And then, so even though we have inflation moving up, we still actually owe in real terms too more than we borrow usually from where we started from. Okay. What's the takeaway of this weird numerical experiment? The takeaway is the upward movement of the price level impacts the amount of debt we hold. So when we have debt and inflation is high, the value in nominal terms of a debt, the $80,000 of student debt, or the $200,000 mortgage becomes less costly in real terms because that $200,000 doesn't buy as much as it used to. And go the other way, if we have deflationary pressures, then that works out worse for debtors and better for creditors. Okay, we'll take that as it is. But I want to move from there to into government financing for a second. So how shall we do? I'm gonna pause.